Welcome, everybody. Thanks for joining us again. It's August 29th today. Just want to get the date in context. So we're going to talk about some live market banter. We're going to talk about some of our holdings and our returns for the year. So I have Matteo and Rob with me in the room. I don't think these gentlemen need any introduction, but let's get it going, guys. So Rob, welcome to town.
Well, thanks. Nice to be here.
Yeah, the traveling man.
Yeah.
Graced us with his presence once again.
Jamie asked me what I wanted to talk about, and one of the things I wanted to talk about is something near and dear to my heart, which is market timing. And people who know me know what I think about market timing. And the last 12 to 18 months that we've been through in these markets are a perfect microcosm of why you should never try to time the markets. So as long as 18 months ago, we were hearing that we were going into a recession, that the world was going into a recession, that interest rates were rising, and that had to cause a recession. During last year, I made notes. I often watch CNBC, and sometimes if somebody interesting comes on, I make notes. And then I keep them, I look at them at the end of the year. And I went through a few of the notes, and this is what I found. In May, there was a Harvard professor came on. I don't recall who he was, saying that it was a perfect storm of China GDP falling, recession in Europe due to the Ukraine war. And his conclusion was we're going into a recession, which will be very negative for stocks. The same day, Paul Tudor Jones was on CNBC. He is a well-known hedge fund manager who's been in the business for 40 years.
Legendary.
Absolutely legendary. And what he said was, I can't imagine a worse environment for investing in stocks. About a week later, on May the 15th, David Rosenberg was on BNN. Surprisingly, he was negative. He's always negative.
Rosy negative. I've never heard of it. Never heard of it.
His quote was, if Canadian investors think that the market has bottomed, they are sadly mistaken. I see at least 10 to 15% more downside from here. I think the big one was June the 1st, Jamie Dimon, the head of JP Morgan, 67 years old, mega wealthy, mega respected on Wall Street.
Warren Buffett has called him the best banker of all time ever.
Yeah. And he came on to CNBC and said, I see there's going to be an economic storm coming on the horizon. I think now will be a hurricane. The market sold off on that for days based on what Jamie Dimon said. Then Ken Langone, who's often on CNBC, and the guy who started Home Depot said the U.S. is definitely in a recession, and I see 10, 15, or even 20% lower prices on stocks. And again, Jamie Dimon came on in July and again said how bad things were. So we heard nothing but the talk of recession, which should lead to lower stock markets. And the reason I wrote all of these things down is because I didn't believe any of it. I didn't believe you could predict the recession. I didn't believe that you could predict lower stock prices. And so here we are. In the last 12 months, the stock market, the U.S. index of 14.1% positive.
To this year to date, we're actually at 16.7 for the S&P. So pretty phenomenal return. I don't even want to go to the NASDAQ because it's some insanely huge number.
Yeah.
And in Canada, we've had a much more modest, but still respectable 5.4%. So
yeah.
2/3 of the way through the year, those are pretty great returns.
They're great returns. And what happens if you miss some of the best years? This has been a great year. What if you missed the year?
Yeah, and just before we talk about that, Rob, I just want to go back. I know you and I are always looking at the market and looking at earnings and trying to understand, where we come from. So just to paint a picture of what the landscape looked like back, I think towards the start of the year, if you look at the rate of change of earnings growth, whether it's at the median or the average, we were at about -7% at the start of the year.
Yeah.
Today, we're maybe flat to slightly down. But look at what the market has done. And we all know earnings drives the market, right?
Earnings continue strong. And by the way, I wanted to make one point. I'm not belittling any of the people who made these comments. I'm just saying that some of the smartest people we see every day can be wrong about market timing and economic timing. So why should we try? Why don't we just find great businesses to buy?
Yeah, and just to further the point on market timing, I mean, look, we've all seen and heard the data, but I'm going to try and bring it up again just to remind everyone. If the market annualizes over a 20-year period, let's call it 9%. And I believe it's if you miss the first or the best 10 days. So remember what you have to get right. You have to get getting out of the market right. You got to get back in at the right time. You got to pay to do both those transactions. If you miss those best 10 days, your annualized return is cut in half, if not worse.
Yeah.
Yeah, it's wild.
You know, so good luck on trying to take 10 days out of 20 years.
Yeah.
You can't do it.
Yeah.
So let's dig into our portfolio a little bit. Rob, a couple of weeks ago at one of our portfolio management meetings, you made the comment that even if the market turns negative for the rest of the year, you feel confident that our portfolio could still turn out a positive return.
Yep.
So let's talk about a couple specific names. Now, again, these are time sensitive. It's the end of August, but we do want to talk about the process, and in doing that, some of the specifics of how we ended up buying and selling some names.
Sure. So the reason I made that comment was, even if the market goes bad, and it might do badly, the indexes may do badly because of some very heavyweight names that are in the indexes. We've got a portfolio of stocks in Canada and the States that are projected to collectively generate a double-digit earnings growth this year, next year, and the year after. And if you start getting a weak market where people aren't chasing some of the the gas in the tank names, the big high growth names any longer, they will look to those names that are generating solid returns year after year, solid financial returns year after year.
Yeah, and let's not forget, I mean, our premise, our foundation of what we do is earnings drives stock prices. So earnings at the portfolio level, earnings at the stock level are paramount to what Rob and I do every single day. And that's earnings, whether it's quarter over quarter, year over year, trailing 4 quarters, expected next year.
Yeah.
It's the foundation of what we do.
Yeah.
Okay, so let's talk about this as the rubber hits the road.
Okay, sure.
Here's a name we've added to our portfolio this year, Booking Holdings.
Yeah.
So let's talk about why Booking was added. What part of the process led you to get to Booking and say, this is a name we need to own out of the 30 or so names that we've got.
And people probably know Booking as Priceline.com. I think it was Priceline before it was Booking.
Yeah. They own kayak.com. They own the one you use to book restaurants.com. I forget what it's called.
Yeah.
But anyway, it's an online booking for travel, whether it's air, hotel, car, restaurants. You've probably used it, if not under that name, under a different name.
I don't know. They own OpenTable?
OpenTable, that's
the one. Yeah.
OpenTable, that's the one.
And our thesis was that the world is opening up again. People are traveling again.
Right.
People are going to spend money on hotel rooms. I saw the CEO of a major U.S. hotel chain on CNBC earlier in the year saying that they had record bookings, very, very low vacancies, and extremely high room rates. And so what we did was we looked through companies in that sector, and we found what we thought was the best name in that sector based on the analyst coverage, based on the earnings expectations, based on the increasing earnings over the next few years, a clean balance sheet. And Booking seemed to fit the bill the best.
Right.
And so that's why we landed on that name.
Yeah. Excellent. All right. Well, let's stay with the theme, being at home and then getting out there. This is the being at home part. This is a long-term holding in our portfolio. We've got Comfort Systems.
Yeah.
I picked that one because boring. Oh my God, it's boring.
Yeah.
Except for its returns.
Yeah. Except for its returns. And I bought that actually before you came on board.
Right.
We were in the middle of COVID,
right.
And air quality was a problem and is a major problem in buildings. And I kind of
HVAC systems.
Absolutely. And I kind of thought there's probably going to be a lot of tenants who are saying to their landlords, we're not going back into our building until you can guarantee air quality. And so that's what they do is heating, ventilation, air conditioning systems, very large scale systems. And the stock has done extremely well. And we see no reason to sell it. You and I see the earnings estimates. We see the numbers that are generated by the street every single day, and they continue to look good. So we're not going to sell it just because we have a profit. We think that the stock could go considerably higher.
Excellent. Okay. So got into the portfolio for a good macro reason plus good fundamentals. Stays in for continued good.
Absolutely.
Excellent.
Yeah, let's not forget our overall strategy in terms of how we make decisions is a guideline, and it's a multi-factor approach. So not only is price one of the factors, but we also look at, as Rob touched on, how much debt do they have? What's their level of valuation? How fast are their earnings growing? What's their reinvestment rate? So it's a number of factors that we look at in addition to price.
Yeah.
Okay, it doesn't always work.
Yeah.
So let's be humble, talk about one of our losers in the portfolio that we actually just exited. We exit losers, or we tried to. Dick's Sporting Goods. Unfortunately, this one came after an earnings release that was pretty terrible.
Yeah.
So let's talk about why we owned it in the first place and why we sold it on that earnings release.
Sorry, I want to correct you. It does work, which is why it's no longer in the portfolio.
Yeah.
Fair,
And-
but the point is they're not always
agree.
they're not all
Yeah,
winners.
they're
No,
not
no,
always
I just want to have a good batting average.
Yeah, and I'm very happy
That's
to
right.
talk about the winners, but I'll let Matteo talk about the losers.
Yeah, look, when we put the lens on what we own, we are looking for, particularly in this case, right after a company's earnings report, if they miss expectations, if they talk about lowering their guidance, if they talk about earnings decelerating, these are all clues to Rob and I to say, hey, let's put another lens on the company. Do we want to continue down the path to own this company? Because again, we have to ask ourselves, what was the reason why we bought it?
Yep.
And if it is no longer in place, then we have to sell it. And that's exactly what happened with Dick's. They announced their earnings. It was not a good earnings report. They guided down for the next quarter next year. And I mean, part of the reason, and this is a first in my history of investing, probably in Rob's, is it was due to shrinkage. Part of the reason why they missed their earnings, missed their market.
Yeah, I was going to say define shrinkage.
Yeah,
We've
heard shrinkage in the past where trucks go missing with inventory, but this is due to theft and crime
On an organized basis.
on an organized basis,
Yeah,
causing margins to be brought down. So right the day after they make that announcement, Foot Locker, Nike, a whole bunch of other companies came out and said, yeah, we have an issue with theft
yeah, and we just
at the retail level.
and we can't quantify what theft is,
No.
and so we have to make an unemotional decision.
Right.
We are not married to these stocks. These stocks are not our kids. These stocks are just stocks, and this stock is not performing well, and we don't see a lot of hope. And we can find other things that we like better. So make the unemotional decision to cut our losses and move on. And the truth of the matter is nobody gets 100% of the stocks right.
Yeah.
Right.
But the key to being a good portfolio manager, an effective manager, is recognizing your mistakes and knowing when to sell them.
I think, you hit it right on the head, Rob, is a good portfolio manager knows when to be humble.
Yeah.
And I think, that this is the time where, yeah, we've cut our losses, we move on, reinvest, and our true opportunity cost is not taking, the 75, 85 cents from a dollar, if that's the case, and buying the next booking.com or the next, stock that looks great and continues to increase their earnings and do well in price.
Yeah.
Right.
Yeah.
All right. So that's led to a nice year to date for our US growth portfolio, almost 13% as we round out August. So that's pretty great. We're lagging the index. The index, as we mentioned, is somewhat heavily weighted to some momentum names that are not going to screen well for us.
I think if you took the top 7 or 8 performers out, the index is flat to down this year.
Yeah.
And we can't, as professionals, put all of our eggs in that very small basket.
Look, names, let's use Apple and Microsoft as an example, are probably 15% of the index, 1.5.
Very heavily.
That's not,
Yeah.
there's not a little bit of risk in that. And we all remember what happened to Nortel, and it was 33% of our index.
Yeah. And can I go
That's
back?
one name, right?
Yeah.
Yeah.
And you can't, and you couldn't buy it. You couldn't buy it in that
Right.
quantity and be a responsible manager.
Right.
I wanted to go back for 1 second on the stock selection process and talk about what we talked about this morning. I had somebody come to me probably a year and a half, 2 years ago with an idea that they wanted to buy a stock. They told me they were going to buy a stock. And it was I think it was Coinbase, which is a crypto exchange in the US.
Yeah.
The stock was around $300. There was a lot of fanfare. And my first question is, when are you going to sell it? And they said, well, what do you mean? When am I going to sell it? I'm just buying it. And as we know, like, buying a stock has all the promise of the first day of a new diet, right? Everybody's happy and excited about it.
Yeah.
I asked, when are you going to sell it? And he didn't understand the question. I said, you need to have a process in place as to when you're going to sell a stock, when you buy it. And the process isn't, I'm going to sell it when it goes up, or I'm going to sell it when it goes down. It's, you've got a set of rules that you abide by on a unemotional basis to make those decisions, and that's how we think about it. The day we buy a stock, we're thinking about when we sell it.
Yeah, and I think that's a classic mistake that many portfolio managers make over time, is they don't have a sell reason or a discipline or a true understanding of what will cause them to sell a position that they bought. And it can't be just price alone.
Or they can't separate themselves from the emotional aspect of, well, I can't sell it now at 30 because I bought it at 50. Yes, you can.
Right.
And you have to, because either it is going to get worse or you found something better. It's as simple as that.
Yeah. Yeah.
Okay, let's shift to Canada. We've been talking about our US portfolio. Our Canadian dividend and growth portfolio is also having a banner year, about 7% year to date. That compares to the index at about 5.5%. So it's nice to beat the index, but I will point out the index is an arbitrary measure, as we talked about. Any comments on the Canadian portfolio or the Canadian landscape broadly in macro?
I mean, financials have struggled in Canada. They're a large part of our index. I think a lot of our healthy return has come from our industrials exposure.
Yeah.
Our index is a bit of a strange makeup relative to the US.
But we're nuts and bolts guys.
Yes.
You won't find a lot of resource-based stocks in our portfolios, because there's nothing we hate more than getting the name right and the resource wrong.
Yeah, the volatility attached to resources, whether it's energy, materials, or related to that, is very significant.
Right.
And we've decided to not be exposed to that type of volatility, particularly in the Canadian index.
Okay, well, let's dig into a couple of changes that we made this year. You spoke of financials, and we added Equitable Bank.
Oh,
so talk to us about Equitable.
I'd love to talk about Equitable. As a lot of people know, I've owned Home Capital on and off for 20 years.
Which, by the way, gets taken out
yes,
today.
Yeah,
Today
yeah, it's being taken over.
And Home Capital.
And people who have invested in Home Capital, institutions who have invested in Home Capital, which is an alternative lender, they lend money for mortgages, among other things, mortgages where people can't get standard bank financing. The banks have really tightened up. These people are very good credit, very creditworthy. And yet the banks won't give them mortgages. Home and Equitable were both very big in that. If you invested in Home and Home is getting taken out today, your money, if you still want to be in that space, needs to go somewhere. Equitable is the most likely. And so we've actually been seeing that over the summer as money flows into Equitable and out of Home from usually the larger institutions. And Equitable, people say, oh, what about this possibility of an economy doing badly, and people who couldn't qualify for bank credit are having to go there. Aren't they going to default? Well, what's interesting about the clients of Equitable is they're the working class. And frankly, the working class have more jobs than they have people right now. These people are fully employed. They're going to be the last people who don't make a mortgage payment. And the fact is, these companies get 50 to 60 to 70% loan to equity on these mortgages. So they've got a lot of equity in their houses, and Canadians don't default on mortgages. It just doesn't happen in Canada. It's not like the US where you could just throw the keys in the drop slot at the bank. It doesn't happen. And so business is extremely good. And even with the growth we've seen in the price of Equitable, the stock is still extremely inexpensive.
Yeah, trading at 7 times earnings.
Ridiculous.
Last times I checked.
Ridiculously
I don't know
inexpensive.
PE is the best way to measure a bank, but still
Yeah,
cheap by any measure.
ridiculously inexpensive
And
and
earnings
banks
are
are,
growing very healthy.
yeah.
So the whole doomsayer concept of Canadians are over leveraged and the banks are the sharp point of the spear on that potential blow up, that doesn't concern you?
No.
Straighten up. All right.
Yeah, I mean, I've watched economic cycles with home capital for over 20 years and it never happens.
Right.
Some of the banks announced this morning, and I looked at sort of their reserve ratios and what they put aside. So they put aside 3 times what they had before, which makes sense. Interest rates have tripled from 1.5% to call it 6% or so. Okay, so they put more reserves aside, but as Rob said, Canadians behave very differently in terms of debt than Americans do. So
Right. All right. We also just removed TransCanada, or TC Energy, as it's now known. It has been a negative performer for basically the whole year. I'm a macro guy, so I like to point at the interest rate story. But what else did you guys see in removing that from the portfolio?
One of the things, well, I mean, they haven't done well on their earnings. Their guidance continues to be very lackluster. They're now going to split the company off into 2, and we don't really know how we can quantify that.
yeah, I mean, they announced the split off of a division. Their dividend yield is very high. Their payout ratio is high. So our concern was, what is the impact of this division being sold off? How does it impact the dividend? What's the potential for, a cut there? So we couldn't quantify that.
We don't know.
Yeah.
We don't know. We don't want to own a stock where we can't have some visibility as to what's going to happen in the next few years, and we can find other names to buy. We've always got a buy list going.
Yeah.
And it was an opportunity to put something in that we've been having a look at for a while now.
Excellent.
Yeah.
All right, guys. Any final comments? I think that's all we got for today, but I'd love to hear any final comments that you've got on the portfolios or on the investment environment in general.
I think we're excited, for the rest of the year, excited by the fundamentals and what our portfolios look like, and just keep it going forward.
Yeah, absolutely.
Thank you.
I'd like to remind everybody, we have talked about some specific stock names. These all come as part of a portfolio. And so the process that we use to add and remove names to the portfolio, we just wanted to highlight to everybody today. Please give us a call if you've got any questions or comments or anything else you want to discuss about your investment portfolio. So thanks for joining us today and have a great day.
Thank you.